first guest for today. Joining me is Foroze Aziz, who's the Deputy CEO at Anand Rathi Wealth. Great to have you on the show, Foroze. As usual, I want to check in with you. Last week, we saw the Nifty, down by about 2.5%, 6 incessant days of selling, but Friday was a bounce. Going forward, do you think that this was a dead cat bounce, or do you think, the worst of the selling is perhaps behind us?
Good morning, Nanda. Point one, yes, like you rightly said, we had 6 successive days of market correction. But if you look at it, it was also the month-end expiry. 26th October was the last Thursday of this month. When you saw the kind of carnage in the market, which is consecutive days, you also like to see what kind of roll cost happened in that expiry. If you see the roll cost or the futures ended at premium, November futures ended at a premium about 120 rupees, which is marginally more than the cost of carry from a treasury bill perspective. So that automatically said that we were oversold, and that's why the bounce, point one. Point two, when it comes to markets, people generally digest the gains which have come in the past. But if you look at, we are just about 6.6% lower than the peak. If you look at the last 22 years, 23 years of history, the drawdowns every year average have been 14, with 4.8 being the minimal. So I don't think this is a correction which is substantive enough for a person to be worried from a investor standpoint. Because if you're looking at the average of the last 22 years, leaving the GFC, which is the global financial crisis, and the COVID years, which were exaggerated years, you leave them apart and there's a 14% drawdown from peak to trough each year. And if you include them, then the drawdowns go to almost about 17-18% average a year. So I think we are not in any zone of a sensible correction, I would say, because 6.6% from the peak is not such an exaggerated move from a profit booking standpoint.
Right. Speaking about the earnings season now, Foroze, since we are in the midpoint of the earnings season, till now we have, we have numbers. We've had numbers from the IT pack. We've had FMCG report numbers. We have had the private banking names as well, reporting their numbers. So, among all the sectors, post earnings season, which one would you say that is worth a look at the current juncture? Because given the fact that IT, was not such a major disappointment, as the street was already factoring in weak set of numbers, and of course we saw what happened with Infosys, trimming the higher end of the guidance. So after earnings, how is the entire IT pack looking to you? And what about the banking pack? Margin pressure was something that the street was factoring in for banks as well. So between the two sectors, which one would you pick right now?
So if you look at, I personally think IT was oversold. If you look at a few months back, even bad results the previous quarter were resulting in stocks doing well on those specific days. A clear indication of being in the oversold territory is bad results resulting in some degree of up move. So that's a great sign of a reversal. Point one. I think the kind of IT spending which has slowed down, especially from the Europe, that has been factored in. Point two. Point three, I think that IT has the potential to deliver an alpha over Nifty by about 4-5% in the year to come. It's very important to, when you look at sectors, you have to have targets in terms of the differential performance with Nifty, especially for a major sector like IT. And I think about 4-5% alpha. Last 1 month, it has underperformed Nifty. But I think on a 3-month basis, it's outperformed by about a couple of percent. So I think in a year's time, Nifty IT has the potential to deliver about 4-5% alpha. All your sector calls, if they can add up to getting you 3-4% alpha on Nifty, that's when the game becomes interesting. And I personally think banking as a sector is a little high beta sector. I personally think that you have to be very choosy in the high beta sector from a business model standpoint, because everybody has different USPs and strengths. And especially in a year preceding election year, I would be very, very cherry picking the high beta sector, especially given the fact that that sector holds about 34% weight in Nifty currently, BFSI.
Right. But what about the auto pack? I think we've seen stellar numbers coming in from Maruti. Auto sales have also been picking up. Of course, festive season is upon us. Volumes have been improving. Do the auto names warrant a buy now at the current juncture?
I think in another couple of months, I think auto would be a great bet, because the rural spending is going to go up. The government has planned to advance the spending in terms of the capital expenditure and finish most of it in this calendar year. About 80% of it, 48% growth in capital expenditure has been seen. I personally think auto sector I would not go bullish today, because if you have to beat Nifty, you have to tweak the weights. I would not be overweight auto at this stage.
All right, not overweight at on autos at the current juncture. But what about sectors that are over-owned by the FII community? Of course, at the start we spoke about how FIIs have been sellers now. Any sectors that are an avoid aside of metals for one, given the fact that we've seen quite a bit of grubbing coming in when it comes to the metals basket?
Yes, you're absolutely right. FIIs have a large role to play in a specific sector depending on their ownership and the cash flow. FIIs over the last 10 days have sold about 6,000 crores. They were largely positive for the first 5 months, except August and September. I think they have been marginally negative. 6,000 crores is not a large number. DII has outdone them by 10,500 crores of inflow in the same period of the last 10 days. I think, like you said, I would say metal is the one sector which is reasonably cyclical, and I will stay out of it. And I think I would be bullish on pharma. And I think not just from a perspective of the next 1 year, but from a long-term perspective, I would be very, very bullish on pharma, because I think most investors don't find it easy to get in and get out of the sector, because it's incidental that you give the advice to exit as well. So I think some sector which you can hold for long period of time would be a pharma kind of sector.
All right. I also want to get your thoughts on mid-caps. When we see some kind of correction, of course, mid-caps are the ones that bear the brunt of that correction, right? So what are you advising your clients in terms of, stock picking? Would you say time to stick to large caps, perhaps, or even look at some of the mid-caps with good fundamentals? What are you advising your clients now?
Yes, Nandana, I personally think we've oversimplified the mid-cap and small-cap category. It's a very large universe. So if you look at large caps, you can be very generic when you're speaking about the top 100 companies of the country. But if you look at mid-caps, especially from mutual fund investor standpoint, it is the Nifty 150 mid-cap. The formation of the index itself is reasonably complex. And I think it's little known that why in the NSE 500 or the small-cap 250 index, there is a 4,000 crore market cap, and some company with a 8,000 crore market cap is not even in the top 500. Because the formation of the index, if you look at the formula of it, a company needs to be in the top 350 to form a part of a 500. So I personally think index in the small cap and the mid cap index have generally been lagging behind, because the way they are constructed has a lag impact of several businesses doing very well and then they're getting included and a person missing out the rally. So point one I'm trying to make is, if you have to be in the mid cap is still okay. If you have to be anywhere close to small cap, the name of the game is to be very specific and at least understand how the index is constructed. If you look at the top 10 weights of the index, they're about 16-17%, if I'm not wrong. So I would say a concentrated top index bet is a better strategy in the small cap space. That's one thing which I'm saying on the basis that most index fund investors itself don't know the logic behind a 3,000 crore being a part of NSE 500 and a 6,000 crore company not being a part of NSE 500. That's because a company, if it has to find itself into NSE 500, needs to be a company which has been at 350 rank as per total market cap before it's even considered to get included.
All right. Lastly, anything that you like in the electronic manufacturing space? This is one pocket that the street is fairly bullish about. The likes of Dixon Tech have reported great set of numbers. So anything you're spotting here, and of course in the capital goods sector as well, given the fact that we are entering an election year.
Yes, capital goods are very, very positive. Not very qualified to comment on the electronic sector. But yeah, capital goods, I think, will give you that fillip because it's also a high beta sector. And I think kind of capital expenditure will result in several infrastructure themes and capital goods doing very well. Of course, you have to buy it not in the positive side. You have to buy things that are tough, which takes more courage. Because you have to be contrary when you're wanting to pick sectors and have active weights on sectors with the objective of beating an index. I personally think courage becomes a very important investor attribute. So any sector which has done not so favorably over the last couple of quarters is the one which comes on the anvil for a choice.
All right, be courageous. I think that's the advice coming in from Foroze. Foroze, on that note, it was great speaking to you today. Look forward to touching base with you sometime soon. But awesome to have a great chat with you this morning.
My honor.